Hi everyone, in this video we're going to be looking at Chapter 12. And Chapter 12 we discuss accounting for payroll and current liabilities. So we're going to start out with a discussion of current liabilities. We're going to look at accounts payable, sales tax, unearned revenue, short-term notes payable, current portion of long-term liabilities, and then we'll get down into the payroll section here for payroll liabilities, which is kind of where I want to focus our attention quite a bit in this chapter. We'll also talk about estimated liabilities and contingent liabilities. So a whole assortment of different types of current liabilities. But like I said, I want to kind of hone in a little bit on payroll, more so maybe than some of the other areas in this chapter. We'll discuss all the slides, but do keep in mind that that's my focus generally for this chapter. And when you look at our test problems and homework, it's going to be more heavily weighted towards payroll liabilities. So we've already talked about current and non-current liabilities in previous chapters. And if you'll remember from those conversations that when we define something as current, that means that we expect it to be paid within 12 months of the balance sheet date. So if it's the balance sheet of March 31st, then we expect it to be all the way up through next February, the 12 months. Not necessarily just ending at 12/31, December 31st, but 12 months out from the balance sheet date. There's a concept that we have here listed out as two categories of liability types, those that are known and those that are unknown, determinable and non-determinable. And so from a determinable perspective, these are things like an invoice that you receive, a specific amount that you're going to have to pay. They note a dividend payable, notes payable, amounts that you know what that is. But then there's also some liabilities that may have certain uncertain aspects to them, and therefore we need to do estimates in order to come up with a figure for that liability. And certain types of liabilities that we estimate could be things like income taxes. As we go through the year, before we get to the end of the year, we're just estimating what our liability will be. Warranty liabilities, so estimates of the amount that if we're selling products that we would have to pay if we get a certain amount of warranty claims from our customers, basically. Other examples that I can think of in the real world that I've dealt with is estimating the amount of the bonuses that you might pay to all of your company's employees. And when you get to the end of a specific accounting period, you want to capture the effect of that expense in that year. But a lot of times the bonuses are paid after the end of the year and still take into account maybe activities that haven't yet occurred at the end of the year, like performance evaluations, etc. And so you just try to do your best estimate based on the available information, and then you will maybe have to do a hopefully minor adjustment when the liability actually becomes determinable in the future. So something just to kind of think about from a conceptual perspective. Bank overdrafts, operating lines of credits. You might have had some bank overdraft fees at some point in your life. That's where you accidentally withdraw more money than you actually have available. And then you can end up with a situation where you have to pay fees and pay the bank back for that. It's kind of an automatic loan that they might extend to you for a certain amount. An operating line of credit is a type of contract or financial instrument that you'll have with a bank where they will allow you to withdraw certain amounts. And it's like an ongoing credit there that you could pull out, up to a certain limit without you having to get a new loan every time. It's just an open line of credit where you go in and you're able to withdraw on that and then repay it, withdraw more, repay it, etc. And you don't have to set up a new loan continuously. So that just helps with certain businesses, especially if there's a cyclical nature to the business. Maybe there's cash flow cycles. And so when needed, having this ability to draw on a line of credit can help businesses maintain operations. And it just makes it more efficient than having to go in repeatedly to a bank and open a new line, a whole new note payable, for example, pay it off, go back in later when you need a new one, pay it off, go back in. This one is just an ongoing line that you can draw on as you need, up to a certain limit, like I said. Okay, which of the following is a non-determinable liability? So we talked about this here. Notes payable, you would know what you owe because it's set by the bank when you get that loan. Dividends payable is amounts that are going to be paid out to shareholders, and you would know what that was based on the calculations. Accounts payable, you'd know what that was based on the invoices you received and what you purchased. But warranty liabilities is really dependent upon how many claims do customers actually file, in a given period. And so we won't really know what that is at a given point. It's more so in the future. And so we would just come up with some sort of estimate, probably based on historical activity, to try and capture what we think is the most likely amount of warranty claims that we would receive. So warranty liability there. The extension of credit to cover the portion of cash if you over withdraw your account, that's the bank overdraft. Not something that is great to have occur. Maybe you experienced that in your own life. I know I've had that a few times in my life when you accidentally withdraw too much, and then you're at the position where you have to pay that money back, and you also get fees usually from your bank when that happens. Okay, we're going to talk about accounts payable a bit here. We've been talking about accounts payable during the whole semester, so hopefully this concept is not something that it should be. Hopefully it's very familiar to you. Obviously a current liability, and these accounts payable are amounts owed to vendors for goods and services. We receive invoices from the provider of those services, and it'll tell us how much when we need to pay it. And so it's a determinable liability. Depends on the specific company and the service, etc. But it will have different due dates. So this is just the kind of transactions we've been recording since the beginning of the course, where we've got liabilities increasing and expenses increasing, and the liability of accounts payable being used, reflective of the fact that we will most likely pay this amount within 30 days or so. We have this subledger that you would be inherent in a system, an accounting system, and so each vendor will have their own, beneath this accounts payable account. If you were to drill down to what the total of this, if you were to look in the ledger, somewhere in the system there's going to be a listing of all the vendors that you actually owe, and so that helps us maintain a listing and know who we're actually needing to pay. Here's a question that talks about timing and accruing the expenses, etc. So a company requests cleaning service in June, receives the service in July, pays for it in September. In which month should the service be regarded as an expense? If you'll remember from earlier chapters, with our method of accrual accounting, we want to record the expense when we incur the expense, when the services are provided, and so that would be in July in our instance here. Okay, in January, a printing company hires a repairman to fix its printer, receives the invoice for the amount of $200, pays the bill in February. How is this transaction recorded in January? And that's where we're going to have accounts payable and expense increasing. Equity is going to decrease because we have the expense being recorded. So it's funny, this is the same, A and C are the same transaction, it looks like, but This one notes equity decrease and no equity decrease. So I think A here should be the answer. And then it asks, how do we record this transaction in February? Now that's this type of this transaction here, no change to equity. We already recorded the change to equity for the expense in January when the service was provided. Now we're just paying off the debt associated with that, the liability. And so now there's no change to equity. We just have cash go down and a liability of accounts payable go down by the same amount. So C will be our answer there. Okay, so sales tax is another liability that businesses can incur if that business is selling certain goods or services. Sales tax, as you can see by the graphics here, can really vary by state, and they can vary sometimes by county, I believe, as well. So there can be some variance there in terms of what the rates are. But if we are a business who is selling some products, for example, if we're selling a TV for $1,650, it tells us, so we received this payment from a customer, but only $1,500 of that payment is actually for the TV, and $150 is the amount that the customer needs to pay to the government, basically. But we, as the business, essentially are required to be the middleman for the government in this instance, where we have to collect the sales tax from the customer, the $150 in this example, and then eventually we have to remit those funds to the proper government entity at a later date, essentially. And as it notes here, usually quarterly, it's sent to the government. So it's a bit of a task that businesses are tasked with, collecting the sales tax and remitting it. You can be audited. You have to, if you don't do that process right as a business, there can be severe consequences. So definitely an important area to consider from a business perspective, because you don't want to get in trouble with the government. And so you can see from their little diagram here, we collected the sale revenue, but we also collected the sales tax liability that we will now have, because we have this money in our bank account, but it's going to be the $150. The $150 will be a liability because it's really the customer's money that is owed to the government. We're just holding on to it and remitting it for them, them being the customer, that is. And there's some variance in terms of timing and things like that. We're not going to delve into the technical specifics of sales taxes in this course specifically, but it is just something to keep in mind. And as we mentioned, the sales tax can vary. So it's just something that you'd have to investigate based on your location, what type of goods and services you provide, all those sorts of things. If you're planning on starting your own small business, for example, you will want to do some research in regard to your sales tax, potential sales tax liabilities and the timing of those, so on and so forth. So here we've got an example problem. So if we sell inventory to a customer for $1,000 cash on June 15th, and we've got a sales tax rate of 6%. So 6% of 1,000 is $60. And so we're going to have to collect $1,060 from the customer, not just the revenue. We get revenue of 1,000, but the 60, we'll take their cash, and then we will increase this sales tax payable liability to reflect the fact that we now have the customer's cash, but we owe that to the government, and then we will remit those sales taxes at some regular interval, either quarterly or annually, to the appropriate taxing authority. Now, if we assume the remittance is made on August 31st, the account has a $60 credit balance. This is just showing the second part of that entry to actually when we do remit or send those sales taxes to the government. We're just going to make cash go down. Again, this is cash that the customer gave us that was really owed to the government, but we held on to that cash for them and did this remittance. And then we reduced the liability at that point as well, because we've now remitted the funds. We have no further liability for this specific sale, essentially. So the amount of sales tax collected by a company should be recorded as a liability. Or we collect that cash, we hold it in our account, but it's owed to the government, the taxing authority. Okay, unearned revenue. We've talked about unearned revenue in previous chapters. And remember that unearned revenue represents prepayments from customers that we receive. So we get the cash into our account again. And then at that point, we are obligated in the future to provide some service or sell a product, for example. And so examples of this include things like advance payments for a 1-year magazine subscription, for instance. And so we can say, as far as these unearned revenues go, in the first period, we receive cash, we record a liability, but then each month after that, as we actually earn, say, for example, if it's an annual subscription, we'd earn 1/12 of that total annual payment every month. And so we would reduce our liability by 1/12 and record revenue for 1/12 at the end of each month going forward. Because once those months have passed and you've sent them the monthly magazine, you've basically fulfilled 1/12 of the requirement to satisfy this full payment that they paid you for originally. So this is basically saying the same thing. If you're a magazine publisher, you receive this cash on the last day of the year, it looks like here, for the following year. So we have an unearned revenue liability. We haven't earned any of this cash yet. It's sitting in our bank account. But then each month, we're going to reduce the unearned revenue liability by 1/12, and 1/12 of the 120,000 we talked about there previously is 10,000. And so we earn $10,000 a month. And so little by little each month, that $120,000 of cash that we received does become ours. It will no longer be a liability at the end of the period when we've fully satisfied the payment, what they paid us for, sending 12 magazines over the year, basically. Okay, let's see here. This question says, in January, a customer prepaid for a service which was provided in March. In which month is the revenue considered unearned, and when does equity change? So until the services are provided, that it will be considered unearned revenue, and equity will only change when we actually earn it, when, like I said, when the services are provided. So in March, the equity will change, and the revenue is considered unearned revenue in January when it's received. So it looks like unearned revenue recorded January, equity change March. So it looks like B is our answer there. Okay, we're the accountant of a magazine. A $120 12-month subscription is purchased by a customer using cash. So originally, we're going to get the cash, and we're going to record that unearned revenue liability, and then we're going to need to earn it every month, $10, 1/12. We'll earn $10 a month as we provide the magazines at the end of each month, basically. So here's that other part of that entry then. As the magazines are provided, there's no entry to cash at this point because we already got all the cash up front. Instead, we're going to reduce that unearned revenue liability with a debit, and we're going to record revenue with a credit here. And then this entry is just backwards, where this would increase the liability. But what we're doing is decreasing the liability, increasing revenue, because we fulfilled part of the requirement there to earn the revenue by sending one of 12 magazines. Okay, this one is a similar problem, but it asks us to kind of do a little thinking here. So we have the 12-month subscription for $120. After 3 months of service, the subscription service has been canceled with a refund for the remaining 9 months. What is the correct journal entry for the refund? So after 3 months, we started with 120. We delivered 3 out of the 12 magazines. So if every month is $10, as we can tell, we've used 120 minus 30. We've got 9 left. 9 times 10 is 90. So if the purchaser cancels the subscription at that point, we're going to need to remit them the unearned revenue portion, which after 3 months would be $90, right? So we decrease cash by sending that refund back to the customer, and we get rid of our liability here because we have no further liability. We already, it's them canceling the contract basically eliminates any future liability we have, and we gave them the money back, and so we're cleared out at that point. So what is that? That's B is the answer there. A consultant receives $1,000 up front for services to be provided next month. When does the equity change? Remember, the equity changes when the services are provided, so next month, B would be the answer. In April, a company receives a $5,000 prepaid deposit. In May, $2,000 worth of services is delivered. In June, a refund is sent for the balance. Which of the following is true? So when we earn the revenue, let's see, that was in May. So in May, our equity went up, and that was the only time that equity would have changed. Otherwise, it's just cash going in and then cash being sent back out. So in May, we increased equity by $2,000. That's the answer there. We earned revenues basically of $2,000 in May. Okay, short-term notes payable. We've talked about this a little bit in a previous chapter when we discussed the classified balance sheet, and we have separate sections. We have more of we have current and non-current sections, and certain portions of notes payable can be considered current or not, not more short-term, basically. But there's also short-term debt instruments here that can also just be something less than a year. You can take a bank loan out for less than a year, and if it's less than 12 months until you repay the full amount of that loan, then we're going to want to include that as a current liability on the balance sheet. So they're just mentioning here that there is sometimes, and don't worry about this too much, but this is a situation that arises sometimes where if a company purchases something on credit, and maybe it's, it would be an accounts payable originally, but if the customer needs to extend that due date of payment, maybe it would make sense to change that accounts payable, which would be due in 30 days or something, to a notes payable, which might give 6 months to make the payment because the customer needs extra time, but will also have some interest component associated with it. So that happens occasionally, and you might see a problem where it asks that, but it's not something we're going to have extensively tested on or anything like that. So here's just kind of the run-of-the-mill debt incurrence transaction. We got cash. We have a liability for the same amount. We have to repay this in 6 months, so it's current. That's what we look at to establish current versus non-current. And we've got an annual interest rate of 5%, so we'll have to account for the associated interest there. And in this instance, after the 6 months, we're just, making the full payment of principal and interest at that one time. So to figure out our portion of interest we owe, this is a reminder from earlier chapters as well, is we take our $5,000, our principal, times the interest rate, 5%. So that would be $250 for a full year. And then we're only holding this note for 6 months, so we can take 6/12 or divide by 2 times 1/2, whatever, to reduce that $250, which would be the total for the whole year, down to the total for 6 months, so $125. and we pay that full amount back to the bank. And this is essentially the same thing. It's just saying you borrow money. Yeah, it's pretty much the exact same problem there. Now, if we do have to accrue interest throughout, remember how we do that? We looked at this previously as well. And so depending on when in this instance, we're saying, we borrowed this on February. So February was the first month, and then our year ends on June. So we had February, March, April, May, June. So 5 of the 6 months were in 20, or, we're in this year. And then 1 of those 6 months will be in the next year. So that's why we have to do this accrual to make sure that we get this portion of the expense, 5/12, into the current year. And we record an interest payable component that we will then pay in the future. And then I think they'll probably show us the example here. Yeah, so when we actually make the payment in the future, you can see this is the first month after the end of the year. The full amount of principal is paid back, the payable portion is paid, and the interest payable piece, the interest expense is applied to that 1 month in the following year. And we make the full payment in cash of $5,125. So sometimes we have to do that accrual entry and the interest payable to ensure that we capture the expense in the appropriate period. And that's what we've done here. Okay, this company has a $100,000 loan paying 6% per annum. So that means just annual 6% interest. So that would be what, $6,000 or $600. Let me do some math. $6,000. Right. Okay. Yeah, that makes sense. Okay. So we would be paying $6,000 of interest per year based on this information. We have interest payments that are made twice a year on January 31st and July 31st. We have a fiscal year that ends on September 30th. How much interest should we accrue on September 30th? So this one has kind of a decent amount of moving parts. So we got to kind of think back and look, when was the last, interest paid? And let's say it was on July 31st, as they tell us here. And we're assuming no principal payments are made. It tells us interest payments only here. So that 100,000 is going to stay as our base to calculate our interest. So if we last made the payment on the end of July, then we have the months subsequent to that. So we've got August and September, July, August, September. So we have 2 months of accrued interest that we're going to need to record between the end of the last payment time and then the end of their fiscal year period. And so if we take that 6,000, which is the whole year's worth, we divide it by 12, that means that $500 of interest expense per month is the charge. And if we just have 2 months, then we need to accrue 500 times 2, which would be 1,000. And here's kind of the breakout. So yearly interest, 6,000. Interest for 2 months, August and September. And the reason it's only those 2 months, remember, is because we made the last payment on July 31st. So we would have recorded that portion of the expense then. And then we just need to record 2 more months that accrued, has not been paid yet, but by the September 30th year end. Here's an example of that circumstance we talked about previously, in which customers, if they're having trouble paying an accounts payable, an invoice, for example, the vendor might say, okay, we'll give you more time to pay it. We'll convert it to a note payable, but that will come along with some interest. So that's why the vendor might want to do that, just to earn some interest and also to keep maybe a good relationship with this customer. So What we need to do to transition from an accounts payable to a notes payable is just to decrease the accounts payable with the debit, they're both liabilities, and then increase the note payable with a credit. So it's really just transitioning from one account type, one liability type to another. So here, kind of an extension of that problem, if we convert 10,000 from accounts payable to a note payable, the amount will be paid back in 1 year with an interest payment of 7%. And what's the correct journal entry to accrue interest for 1 year? So again, it's just 7% times the principal, so $700. Interest expense, it's a debit, it's an expense, it's going up, and then the payable is the other side. So we've got B as the correct answer there. Okay, and extending this problem through then, it's saying now you're going to have the payback time, you're actually paying it. The last entry was just to accrue the liability, but now we're actually making the payment, and so we're going to reduce our interest payable, we're going to reduce our note payable, and we're going to pay cash to get that done. So again, B. I feel like B is the common answer on a lot of these quiz questions. Okay, let's talk a little bit about the current portion of long-term liabilities. I started talking about this in the last section, and we have talked about this previously when we've discussed the classified balance sheet that breaks out liabilities into current or long-term portion, etc. So whatever portion of a given loan will be paid within 12 months, that's considered the current portion. Here is an example. We say on January 2nd, 2018, we take out a loan of $50,000 with a term of 5 years, bearing an annual interest rate of 5%. Of that debt, $10,000 plus interest is payable every December 31st. So when we take the loan out right away, our first thing is we get the money, we establish the liability. So assets up, liabilities up. And then on December 31st, the first installment plus interest was paid, and we can see that transaction here. So it tells us we're paying this over 5 years, so the principal is just 50,000 divided by 5. And then we multiply that, the total amount, so the 50,000 times 5% means that we owe $2,500 at that first payment for a whole year, basically. Something to really keep in mind here that's important is that the principal, the outstanding balance of the loan, now that we've paid back $10,000, that's going to reduce down to $40,000. Now, we're going to make another $10,000 payment at the end of the next year on December 31st. This will be continuing every December 31st, basically. So that'll be 12 months out. So the current portion within that next 12 months will be $10,000, and then $30,000 will be paid after the next 12 months, and that will be the long-term portion. So you can see that. That's what's mentioned down here. Okay, work problem on January 2nd, we borrowed that money, 4 years, 6% bank loan, $2,500 plus interest is payable every January 1st. How much is the current portion of the loan at December 31st? 2018. So we're paying it on January 1st. So we're at the end of December. We've basically accrued a full year of interest, but it's just asking about the portion of the loan. So if we're making a $2,500 payment every period, then the current portion of the loan is going to be that $2,500. Now the journal entry to record this loan payment on, it says January 1st. We will, let's see, what are we going to do? We're going to debit loans payable of $2,500. That will be part of the journal entry. Crediting loans payable would be an increase. A debit to interest payable of $3,100 would be too much. That would make sense. And a credit to cash of $2,500 is too small, because not only are we going to reduce the $2,500 of cash to reduce the loan payable, but we're going to have to pay some interest back. And I think it will be a full amount of cash payment of $3,100 with $600 reflecting the interest portion, and then $2,500 being the principal. So again, yeah, a reduction in the liability of $2,500. Okay, as I mentioned, now I want to spend some time on payroll liabilities, and this is where you're going to see a lot of the work problems focus in on, because we've already talked about a lot of these other concepts in previous chapters, whether that's interest payable calculations or unearned revenue, accounts payable, so on and so forth. Those are all current liabilities, which is the point of this chapter. But the new thing that we haven't talked about much is payroll expense and payroll liabilities. So that's kind of the highlight in this chapter for me and what I want to communicate and teach on mostly. So we have this idea of an accrued liability. And we've talked about this a little bit, I think, in previous chapters, accrued expenses, where if we have a payroll period that extends beyond the end of the month, for example, we will want to accrue a portion of that expense associated with our payroll in a given month, and then when it's actually paid in the next month, we reduce that payroll liability. And the amount of payroll, so the things that we have to consider when we are determining what our payroll liabilities are going to be, we have to consider the employment law and legislation. We have to consider taxes, which would be amounts deducted and owed to the government, other relevant organizations, employer payroll contributions. So that can be things that we pay, whether that's taxes or if we're doing a retirement plan match, a 401k plan match, etc. Those are all important concepts to have in mind. And I will say that we have a class at Butte College specifically focusing on payroll too. So it is a deep topic that you could really dive into, a lot of technical aspects. We're going to provide a general overview of payroll expenses, liabilities, etc. But if you want a deeper dive on that, then there is a full class that you can take to really get into the details. But from our perspective here, we're going to want to know what gross pay is. So these concepts, which we've talked about previously, of gross and net. Gross is the amount before deductions. Net pay, whenever we see the term net, it means that we have reduced the gross number to get to a net figure. For example, net sales that we talk about is our sales revenue net of or minus the cost of goods sold, right? So similarly with pay, and it's an expense, for the business as we're paying our employees. We pay them a gross amount. We actually pay them a certain amount, but we have to deduct certain things from that pay. We have that responsibility for things like taxes, for example. It is again, not only do we have to collect and remit sales taxes from customers, we have to collect and remit income taxes and other types of taxes from our employees. So as a business, we do have quite a heavy responsibility load when it comes to collecting and remitting taxes, especially if you have employees and you sell things that are subject to sales taxes. So just something to keep in mind. Can't get away from the taxes. So this is just an example of what a payroll register might look like here, and this is just basically a listing that every business is going to have something like this if they have employees, because the employees are paid different amounts. They might work a different amount of hours. They might make different selections on their withholding forms so that they withhold different amounts of federal and state income taxes. They might make different selections about whether they are putting money into their retirement 401k plan type of thing, whether they have health insurance. Maybe certain employees have health insurance through their spouse, so they don't get a deduction, so on and so forth. So with this whole register, what we do is we really just list out individual employees and then get the totals so that we can then make sure that when we're doing payroll, we're paying them accurately. Of course, that's extremely important, but also that we're accounting for those payments accurately as well. So let's look at look at an example here. We have a company, Rufus Construction. So gross payroll, again, before any deductions, for the period ending January 31st, 2018 is $15,000. And that's broken down between the sales department and the office salaries. So our sales salaries expense is $11,200 and $3,800. Combine those together gets us to $15,000. And again, that's the gross amount. The net actual amount that the employees will receive in their paychecks is this salaries payable portion. So this is the full amount that they are basically paid, or at least that they've earned, or the expense we've incurred. But we, again, as I mentioned just a moment ago, we have to collect those taxes from our employees and remit them to the government, essentially. So when the employees actually get their paychecks, and you might have some personal experience with this, you might think, oh yeah, I'm getting this big paycheck. This is my dollars per hour that I earned. I worked so many hours, so therefore I'm going to get, just multiply those together. But you'll soon come to realize, once you enter the working world, that taxes can be quite heavy, and they're just something you don't expect, so on and so forth. So that's, I think, one reason why I like to focus in on this section, because it's not only is it an important concept, but it is something that touches all of us who have worked a job and earned a salary, essentially. And so hopefully explaining a little bit might be interesting on a personal level. So again, this is for all of our employees. We do our payroll register, add everybody up. Here's our amount we're paying our salespeople, our office people, and then all of these payables here: income taxes, FICA taxes, charitable donations, union dues, all of this stuff, it's all liabilities. They're all payables. And what this is the money that really it belongs to the employees, but it is our responsibility as the employer to hold that money back, and then in the future, at some point, send that money out to the different targets, the recipients of those payments. So here, the federal government, the state government, FICA is like Social Security and Medicare. So federal government, charitable donations, that's something specific that the company would offer. Union dues, so this would go out to the union, to the retirement plan, the health insurance provider, the insurance company, we'd send this out to them. And finally, as I said before, the net payable amount, which is actually going to be in the paychecks, the cash that's going to go to the employees, is the result of all of the salaries they earned minus all of the money that we as the employer withheld, and they get the rest of it. So sometimes it might feel, again, it can be a heavy burden when you get your check and you're disappointed that you have taxes taken out. And it might not be much of a consolation, but I think what we don't realize is that if the business didn't take those taxes out, and somehow the employees were tasked with remitting their own taxes and paying their own health insurance premiums and doing all of this themselves, you would have to write all these checks all the time and aggregate and figure out the amounts and send them out and all this stuff. So it really is a benefit to you as an employee that the business is doing all of this work essentially on your behalf to make sure that your health insurance premiums are paid and your taxes are paid to the IRS and the state, etc. So something to keep in mind. So total payroll deductions, that's just the summarization of all of these amounts. Then we put all those into this account that we have listed here as a liability for payroll deductions payable. We group these all together here in the example in one account, but you really do want to keep these separate to understand where they need to go, because all of these payments are going to go, at least, I think all of them are going to go to a different recipient. So it's important that that's done right. So here then, when we actually pay the cash to the employees, like we said, that net amount is there. So we have it as a payable first. In this first journal entry, we saw this is a payable. It's going to be paid. And then we actually make the payment. Let's see, where'd that go? That's just the cash going down and the liability going down. Very typical, kind of journal entry we've seen time and time again in this class, just reducing a liability by making a payment. Okay, as an employer, the company would debit salaries expense at the amount equal to the cash pay to the employee is the net amount. We want the gross amount, so the employee's gross pay is what we're going to recognize as an expense, because that's really what we are paying the employee. Here we have an employee with a gross pay of $8,000, total deduction of $2,314 per month. How much is credited in the employer's books as salaries payable when salaries expense is incurred? So the credit is going to be broken down between the salaries payable piece and the taxes or other, let me use their terminology, the other payroll deductions payable. And so if the payroll deductions payable, get back there, is $2,314, we just need to take the difference between those. So 8,000 minus 2,314 is 5686. And so we're going to have salaries payable of 5686 as a credit. And then we'll have payroll deductions payable of 2,314 that we will have to remit to the government. Okay, the next section we're going to look at here in Chapter 12 are estimated liabilities. As we mentioned previously, some liabilities are determinable and some are not. And so these estimated liabilities are ones that are not. And these can include things like we mentioned previously, product warranties, employee benefits, customer loyalty programs. And we basically have to kind of try to do our best to make sure that our estimates are as accurate as they can be. But they are still estimates, and they are subject to variance, from the actual amounts, just because the reason we don't have enough information, the time hasn't passed, so on and so forth, to actually make it determinable. Some of these things might, as far as employee benefits goes, and we might need to estimate the amount for paid vacation usage, pension benefits, health benefits. As I mentioned earlier, employee bonuses is a big one. Usually the employee bonuses are based on an annual performance, at least in my experience. It could be different for other companies. And so we would get to the end of the year and we need to make an estimate for what that total bonus amount for the whole company is going to be, which could be a relatively large amount. But the final determination of those bonuses is, at least in my experience, a lot of times it was dependent upon the year ending. We're recording that liability before the year ends, but we need to see how the year actually winds up being. Maybe a portion of the bonus is related to financial performance that we don't know yet. So it's just a process of making an estimate. You are going to have some variances, and we just have to try to do the best we can, essentially. Here's an example of vacation pay. And so as employees earn this vacation pay, we can accrue that vacation pay liability. So very similar to what we've seen in different instances, but we're recording this payable and the expense. It's not accounts payable or notes payable or interest payable, salaries payable, but in this instance, vacation payable. Warranties, like we said, are a place where estimates are used. And again, if definition of a warranty, it's, if you sell a product and we're guaranteeing essentially that the product will be free of defects for a certain period of time. And if any defects arise, we're going to take those products back and do the work to fix them. And so that process of receiving the products back, fixing them, providing a replacement product if need be, that all has a cost associated with it. So there could be a basic warranty, but also customers could purchase extended warranties. So it's kind of just it depends on the product and what the customer decides to do. So we have this basic warranty. For example, what do we have? Okay, this one says we star machines. We make machines. We have a basic warranty of 3 years included with the purchase. If it breaks down, we're obliged to repair or replace the machine. And then on the basis of historical information, we determine that an average of $100 per machine is paid out in warranty obligations. So again, this is our estimate, but it's not just it's an educated guess based on historical information and analysis, etc. So now, and we can see the company has sold current liabilities, 50 labeling machines. Well, I think that is I don't think that's supposed to be in there. The company has sold, skip that, 50 labeling machines during the 2018 fiscal year. Some weird typo there, but it included that information. So anyway, if we know that on average we're paying out about $100 in expense over those 3 years, we sold 50 machines. So we can say 50 times 100, that's 5,000. And so we can come up with this estimated warranty liability for all the machines sold during this year of that $5,000. Again, it's not a payable exactly because we don't know for sure that this is going to need to be paid. So that's one little maybe nuanced distinction, is that payables are things that will be paid for sure. This is a estimated liability that may or may not be paid. Maybe none of these machines at all have any repairs needed, and so our liability estimate here could be wrong. It's just based on historical information and the best estimates that we have. And it's unlikely that none of them would have anything going wrong with them, right? Okay, so that's the original entry, is to increase liabilities with a credit and record the expense, and that's at the time of sale that we record that liability. And then over those next 3 years, if we actually have expenses for those fixes, let's assume that we had to use $500 in parts and had $1,500 of labor, then we don't record expense at that. Again, we already recorded the expense at the time that we sold this stuff. We just reduce our liability by the amount of cost that we incur to satisfy those warranty claims. So if we have to incur $2,000, then we just we debit that liability to reduce it, and we're estimating. So hopefully we did a good job estimating, and the 5,000 is enough to satisfy the future claims that come through. If we have an an extended warranty that is sold to a specific customer, for example, we're going to account for that type of warranty using a little bit of a different approach, the sales warranty approach. And we assume that star machines, so if we sold $60,000 worth of 3-year extended warranties as a separate product, so here we've received the cash, and we have this unearned warranty revenue, essentially. So we already have the money up front. This one doesn't have any cash receipt associated with it because really it's just included with the price of selling the thing in the first place, whatever the machine is. But when we're doing an extended warranty where they purchase this warranty from us, that's this unearned revenue concept, essentially. We've talked about that a lot. And so then we hold on to that cash. We recognize the unearned warranty revenue will decrease by 1/3 because it's a 3-year coverage period. And so we write down the value and record. We record the revenue and we decrease the liability, the unearned piece, by 1/3 every year in this instance, for example. So at the end of the year, we have a $40,000 balance because there's 2 more years left. And note that only the unearned revenue to be earned in the next 12 months is counted as current liability. So again, remember that concept of separating out current versus non-current. Okay, customer loyalty programs. And maybe I should say, it doesn't dive into the specifics here, but in this instance, again, what you would hope as the business who is selling these extended warranties is that the expenses that you incur for repairs over this 3-year period do not exceed the $60,000 total. And as long as you you've received more cash than you pay out in warranty claims, then you'll be making money on selling these extended warranties. Hopefully you have a good product that doesn't require a lot of repairs. That will lead us to a better outcome there from the business perspective. Another concept is customer loyalty programs. So, if you get store points or travel miles, things of that nature, we're not going to spend a lot of time doing problems with these, but we'll look at it real quick. The idea here is that we have to do, again, this estimated historical analysis. And if we see through our analyses that 70% of the points are redeemed, this example says 100 loyalty points can be redeemed for $1 discount. So they're basically like a 1 cent each kind of a thing. And so when we want to set up a liability to reflect the fact that the customers are going to use these points in the future, we're going to take those total sales amount times our estimated usage percent, that we figure out from looking at historical averages. And we say each one of those is worth 1 cent, essentially. So if we sold 150,000, we're going to do that math and come up with a liability for the rewards of 1,050. And we will have a sales discount. So again, it's a contra revenue that will reduce our net sales. Remember that from the inventory chapter. And we have this liability set up to cover us for the potential usage of these points in the future. So this example, let's see here. So redemption rewards liability, it's a current liability. Once the points are redeemed, the obligation is gone, and unearned revenue becomes earned. So assume that the total value of sales was 180,000, of which 179,250 was received in cash and 750 was redeemed in points. So basically, we're able to reduce that liability for the 750, and we don't get to receive as much cash. So it's a proportion of our sales become loyalty points liability reduction instead of cash, essentially. So that's the whole idea, is that we're allowing the customers to pay less than they would otherwise. Okay, which of the following accounts is credited when extended warranties are sold? So we're getting cash in, that's our debit though, and unearned revenue related to the warranty is going to be our credit, which will be earned over the time period as it elapses, essentially. It's kind of like the unearned warranties that we're selling. It's almost like we're an insurance company at that point. We're selling the assurance that if something goes wrong, we're gonna cover it. So just something to keep in mind. Which of the following accounts is debited when customer loyalty points are issued? So we're going to do a contra revenue, and that's our sales discount, loyalty programs to reduce our net sales overall. And that covers it. Okay, contingent liabilities are a little bit different from some of these estimated liabilities. They're similar, but the word contingent really refers to the fact that some other event has to take place to make that liability come to fruition, essentially. And when we estimate, and that can be something like a lawsuit, for example, so on and so forth. And so if we, as the accountants, look out, maybe talk with HR and the CEO and whoever to understand, hey, we have this lawsuit that's ongoing, for example, and we as the accountants need to consider whether we need to report the amount of the potential loss related to that lawsuit. We follow kind of an analysis here that takes into account the likelihood of us, for example, losing the lawsuit. Is it probable? Is it reasonably possible? Or is it remote? And we also have to determine whether we can estimate or not estimate the amount of liability that will happen if it's probable. And then depending on how this all breaks out, we might not have to report anything in our financial statements here if it's a remote possibility and the amount of loss is not able to be estimated. Even if just it being remote means we're not going to disclose it at all. If it's reasonably possible, we have to disclose it just as a sentence or as a footnote. If it's probable and we can estimate how much the loss is probably going to be, if we're going to probably lose a lawsuit in the near future and we can estimate the amount of liability, then we have to record that in our accounting records and also disclose it in the footnotes to the financial statements. And this provides a little example here of how determinable and non-determinable liabilities would appear. So you can see that we've got a breakout of contingent liabilities as a separate line item, estimated warranty liabilities. So they're just kind of highlighting that having these things well named and documented is important to allow the readers of the financial statements and the balance sheet to understand what makes up total current liabilities. And then this parentheses with it saying note 4 means that there is a footnote or kind of a whole explanatory paragraph section in the financial statements that you can go back to look at if you're reading the financial statements to further learn what this contingent liability is all about. It'll tell you the circumstances and provide some extra detail. So here we've got a question. A company is involved in a legal dispute that has not yet been resolved. The company's lawyers have advised that the dispute is more likely to be lost than won. Should a provision be created or not? I mean, that gets back to the whole idea here. So when they say should a provision be created, that's really, should we record an estimated liability and an expense on our financial statements? I think let me read this again. I would say yes, a provision should be created, but we do need to be able to estimate what that amount is. If we can't estimate it, like it notes here, if it's probable but not estimable, we can't estimate it. And basically, we're going to disclose it in the financial statements, but we're not going to record an actual expense for it. So I don't know if I agree with that answer 100%, but it's fine. And that's a really high-level topic. We're just covering a lot of these from a high-level perspective. Most of the work you're going to be doing from this chapter, like I said, is going to be more so around like the payroll liabilities, maybe a little bit around some of the other concepts, but not so much around contingent liabilities, aside from just understanding what those concepts are. Okay, let's kind of wrap up here as we get to the end with internal controls relating to current liabilities. And these controls follow standard protocol when it comes to things like accounts payable, notes payable. Keeping track of the company's bills and budget is important. You can compare a budget to actual for a given month to make sure that you're not missing any invoices or bills that you expected. If your budget is way different than your actual expenses incurred and liabilities, that might be a red flag that something has either gone wrong or your budget is missing some information. Paying the right bills at the right time. After the invoice is paid, it should be marked as such, so it can't be paid. You don't want to pay a bill twice. That's important. And then just general processes and controls in place to ensure that the resources are being used efficiently and economically. For example, if you're not, we want to have some controls to make sure that we have the liquidity to pay our bills and we're not falling behind on bills, etc. Okay, and that just brings us to a question. So which of the following is not a good control or ethical conduct around current liabilities? And that will be things like paying your bills on time, keeping track. Those are all good. Keeping paid invoices for verification. Reporting current liabilities as long-term to show better liquidity. That would be manipulation of the financial reports, financial statements, balance sheet that we want to avoid. Okay, so wrapping up in summary here for our chapter, we've defined and differentiated determinable and non-determinable liabilities. So the determinable liabilities will be those that we can actually determine the amount owed. Non-determinable will be for liabilities that we're going to have to estimate. We talked about accounts payable. We've talked about this a lot. This is just kind of a reminder of accounts payable. Sales tax we spoke about. This is if you're selling products or services potentially that have sales tax associated with it, and you're collecting money from the customer and then sending that money to the government eventually. Unearned revenue we've talked about quite a bit, so I won't go into too much detail there. You know, it's receiving a prepayment and then earning that revenue later when the product or service is actually provided. Short-term notes payable is just understanding that there's let me separate this out. So the current portion of long-term liabilities, that's the amount of a note payable, for example, that will be paid out over the next 12 months. Whereas there are certain short-term notes payable, and these can be more short-term, like it says, you know, less than 12 months, so on and so forth. Let's see, recording payroll liabilities. We talked about the fact that we have gross payroll expense, which is the actual amount that we owe to our employees. And then we reduce that by different payroll deductions, like taxes that the employees owe. Maybe they have 401k and retirement plan contributions, health insurance payments, all those kind of things. We withhold those from the employee's salary, and then we pay those amounts on the employee's behalf, essentially, or remit the amounts to the government and the other providers. We have to do estimates for certain liabilities, like product warranties. And there's also contingent liabilities that can arise. For example, a lot of times this comes up with the possibility of certain lawsuits that the company could potentially lose. And if it's probable that we're going to lose a lawsuit and we can estimate the amount, we have a requirement to record an expense and a liability, disclose it in the footnotes, so on and so forth. But there's a whole differing level of disclosure required depending on the circumstances and whether they are the loss is probable or not, and if we can estimate what the amount will actually be. And finally, internal controls are important. Payment of inappropriate invoices is one of the main ways that fraud occurs within companies, etc. So you need to have a lot of good controls around tracking and monitoring invoices, all the related documentation. So as it notes here, ensuring that the correct bills are paid on time, they're not paid twice, they're legitimate, they're paid for the right amounts, all those kind of things are really important. And it just notes that there could be an attempt to manipulate current versus non-current liabilities, because changing those ratios essentially there could be a conflict of interest there where the company could have some favorable outcome because they have more long-term liabilities versus current. Maybe a bank has a requirement that the company maintain a certain proportion of the current ratio, for example. And if they're going to fail that requirement, maybe the company's accountants and the CEO or whoever says, hey, let's do a little inappropriate readjustments of our liabilities to improve our ratio so that we don't get in trouble with the bank. You know, those are the kind of things that could possibly happen. And so we have to apply good ethics, but we should also have internal controls that makes it so those kind of situations aren't likely to occur.